This is starting to feel like a family wedding or a family funeral where we all get together with old friends we haven't seen for ages, but we thought we might persuade you to get back to what we're actually here to be doing. So we're moving on to the second panel. Should regulators issue implementation rules for principles-based IFRS? We have Chiara Del Prete setting the scene. Chiara's my boss, so she told me to be polite. But I think you could describe her as, I've done everything and I've been everywhere, lady. Done a lot in a very short time. Stig moves between the standard setting and the enforcement world. So he's a member of the EFRAG Board, and he's working with enforcement agencies in Scandinavian countries. So once Chiara's spoken, Stig will introduce the rest of the panel. So over to you, Chiara.
Thank you, Patricia. So I will start, but good afternoon, first of all. I will start paying tribute to the category of the preparers, maybe underrepresented in the room. But the accounting departments of entities that apply IFRS have recently learned how to navigate complexity, running big transformation processes with change management programs that involve people, organization, IT, data, but also products and services. And implementation rules are a core dimension of this process. IFRS 9, 15, 16, and 17, we all know. The IASB has put particular emphasis on assisting with the implementation challenges of this new generation of IFRSs. The IASB transition resource groups have acted as a transmission mechanism between the IASB and the market, facilitating the start of the process of common understanding of the operational implications of the newly issued standards. So the outcome of this TRG form, as a matter of fact, the basis for supplementing the standards with more detailed guidelines. But in addition to the TRG, who are the actors today of the implementation process? I thought that IFRS 9 offers several lessons. Regulators have been involved in the extensive IASB outreach, and IFRS 9 basis for conclusions include a section dedicated to the role of prudential supervisors when discussing the fair value option and the necessary link with the entity's business model. And the business model, indeed, is one of the most evident illustrations of the trade-off between comparability and relevance, a typical characteristics of the new generation of these principles-based standards, where someone would like to see more detailed anti-abuse rules, while others demand to keep the flexibility to be able to depict the specificities of an entity. So the IASB notes in the basis for conclusion of IFRS 9 that the primary objective of prudential supervisors is to maintain the financial soundness of individual institutions and the stability of the system as a whole. Stability, a word that was mentioned several times in the beginning of our discussion today. These objectives of prudential supervision differ from the objectives of general purpose financial reporting. However, the IASB acknowledged that for the purposes of determining what level of capital an institution should maintain, prudential supervisors may wish to understand the circumstances in which a financial institution can choose to apply the fair value option. So, but let's step back to the past. IAS 39. It was March 2017 when the ECB issued its guidance to banks on non-performing loans. And Chapter 6 of those guidelines include rules on how to run impairment and write-off. So you can read in that chapter that the guidance intended not to substitute or supersede any applicable accounting requirement, but it was a supervisory tool with the aim of clarifying the supervisory expectations regarding non-performing loans, including measurement and write-off. And it is expected that banks do not enlarge already existing deviations between regulation and accounting, And whenever possible, banks should foster a timely convergence of regulatory and accounting views where those differ substantially. And here we come to a second illustrative trade-off between rules-based and principles-based standard. Comparability across industries versus comparabilities within industries. As part of his effort to foster comparability across industries, the IASB does not issue industry-based standards. And again, here it seems that we have a lesson to learn. In December 2015, when the Basel Committee issued its implementation rules for a high-quality implementation of IFRS 9, we may say that such guidance started from where the Transition Research Group ended. That guidance helped to achieve comparable application of a complex principle-based standard across different entities and different countries for entities belonging to the same sector. But another recent example on the same theme, a hot topic, IBOR. Few days ago, 5th November, the Working Group on Euro Risk-Free Rates has issued a report on the financial accounting implications for entities that apply IFRSs. This report sets the key recommendations to assist entities in the accounting challenges of the transition to the new IBOR rates. So, what have we learned in terms of the role of the regulators after the first-time adoption? July 2019, the EBA has published a roadmap on IFRS 9 deliverables. The activity entails monitoring of implementation, analyzing modeling practices, with the scope of promoting a consistent application of IFRS 9, as well as working to sort out the interaction with the prudential regulation. External auditors are involved in this benchmarking exercise. So to take a perspective broader than simply the banking, auditors. Also, auditors are promoters of a consistent application, and Karsten in the first panel mentioned the books of the Big Four. Well, I can tell that they have been very precious in understanding what to do for specific patterns not explicitly covered by the IASB book. At least I can tell from my experience as a preparer. However, always to mention a perspective outside of the banking. Local regulators. We know that local regulators issue detailed presentation disclosure rules, and sometimes as much detailed as to rule templates of tabular form of disclosures and classification rules in the primary financial statements. And what about comparability across jurisdiction then? Do we know to what extent the local regulators are conflicting with the other? And I think we have seen also we have heard the ESMA view this morning on this topic too. So the second panel will address several questions dealing with interactions between regulators and standard setters, whether this is good or bad. And I would like to leave you all with an overarching question. Has the relationship between regulators and standard setters entered into a new dimension?
Thank you.
New dimension.
Thank you, Chiara. Let's first introduce this distinguished panel. Fabio, next to Chiara, is Fabio Goia from the Italian bank Intesa Sanpaolo, where Fabio is head of accounting policy and regulatory rules. Next to Fabio is Darrel Scott, an IASB board member for many years, and a former chief financial officer of First Ranked Banking Group, one of the largest financial institutions in South Africa. Then we have Luca Serafini from the Bank of Italy, where he is head of financial statements and supervisory reporting division, plus chair of the Basel Committee Leverage Ratio Group, and chair of the ESRB Exploratory Group on Accounting Developments and Financial Stability. So an experienced regulator here. And finally, Richard Martin, who is the voice of ACCA on corporate reporting.
Yeah.
And but also chairman of the Accounting Expert Group in EFAA and member of Accountancy Europe's Corporate Reporting Policy Group.
Yep.
So let us start this panel debate and reminding ourselves that the overarching question in this debate is, should regulators issue implementation rules or not? That's the overarching. Then we have some sub-questions that may in the end lead to, or may not lead to, a response or at least some comments to the overarching question. But first, I think I expected to have a Slido question.
Oh, right.
Oh, it's there. Thank you. Are implementation and application rules from regulators needed for implementation of complex standards? So there, kindly ask you to give some input. So do you need the banking regulators and other regulators to tell you what to do? Or is IASB good enough? It's always interesting how it moves backwards and forward, right? But it seems that we have got a direction.
Yeah. Yeah, I think.
That around 60%, 60+% say, no, we don't need them. Implementation rules undermine principle-based standards. That's very neat, particularly when all banking regulators actually issue these things. But let's have a question here. Question one is what to do if there is a conflict between regulators' implementation rules and principle-based standards. And I wonder whether you, Luca, would like to open up the whole debate.
Yeah, thank you very much, with pleasure. It's actually a bit tricky to start the panel by staying in the tail of the feeling of the room, but it was somehow expected. Of course, I'm a banking regulator, and I suppose I'm a bit biased by my role, but nevertheless, I'm going to share with you the rationale behind our approach to guidance, through supervisory guidance. So why, from my perspective, supervisory guidance is still needed? First of all, because IFRS are not industry specific, but clearly there are some accounting standards that hit more certain sectors than others. So if we think to IFRS 9, definitely that it's banking and financial more probably than corporates, and so this is why probably there is an higher interest by regulators than for others. Sectors. Second, financial statements serve a lot of stakeholders, but again, the relative weight of those stakeholders is different depending on the sectors, and definitely for regulated entities, supervisors play a role, have a major interest, also because at the end of the day, accounting fits into regulatory ratios and finally in bank stability. Third, sometimes IFRS, as any accounting standards, I would say, lack operational guidance, and for certain aspects there is an interest by regulators to try to fill the gap. Finally, IFRS provided with a range of options. This because there is a variety of preparers which are different in complexity, in business model, etc. But banking and financial are quite an homogeneous sector, and there is an appetite for regulators to have a certain kind of implementation by banks. Having said that, I think that in any case, guidance from regulators should respect certain rules. So first, guidance should not interpret the standard, but should address implementation issues for those aspects that are not addressed directly by the standard themselves. Second, within the range of options which are provided by the standard, I think that is somehow normal that the regulator has an high expectation by banks in the implementation of certain standards. So I think it's normal and legitimate that the regulator asks bank to choose among the different options, those that are considered more robust from the banking perspective. Third, the supervisory guidance should never overlook the issue of proportionality and materiality. So I think that in any case, guidance should be proportional and should have a clear attention to materiality. The regulator should liaise closely with the accounting standard setters. If I think to recent experience by the Basel Committee on the guidance on IFRS 9, which was mentioned by Chiara, I think that's a very good example of good interaction between the Basel Committee and the IASB to ensure that the guidance is never contradicting or overriding the accounting principles. Finally, the issue of international comparability. So clearly, it was mentioned also in the first panel that there is a potential problem with affecting international comparability if national regulators are issuing prescriptive guidance. But I think that if we move that discussion on the level of the Basel Committee, definitely we can override that kind of problem, because we will, at the end of the day, have a uniform approach by regulators, which is worldwide.
But that does require that national regulators accept and comply with that.
Yeah. But if we think at the European experience, the way the EBA has implemented the Basel guidance, I think that excluding a very marginal adaptation to the European context, actually the same set of guidance has been implemented in Europe as well. So I think at least in Europe we don't have that problem of jurisdictional differences.
Okay, thank you. Richard, do you have any comments to the introduction here?
Yeah, yes. No, well, I suppose I'm rather conscious that the other members of the panel are all ultimately intimately connected with the banking industry, and I'm not. So I guess I'm bringing a sort of non-bank perspective to it. And for the overall question, I would say, as far as the capital markets in general are concerned, that we don't want regulatory implementation rules. I'm a skeptic about whether they're helpful or not. And I think on the whole, IFRS are sufficient. But maybe banks are a special case, and perhaps others who know better about that special case can speak to that. But I do wonder whether if we start talking about banking regulators and capital markets regulators, whether we have got a sort of slightly different perspective here, because I think the banking regulators have their own issues, own concerns, as we've heard about financial stability and about the solvency of the different institutions that they're looking at, and that might not be the case when we start thinking about non-banks and we start thinking about the capital markets in general, and the capital market perspective on the banks. So I just wonder whether there could be a slight difference between the interests of the capital markets and the bank regulators there. The other issue I think I would quite like to raise is a question of we said what to do if there is a conflict. Well, what is a conflict between IFRS and regulatory rules? Luca mentioned closing of options. Is a regulator closing off certain options that have been put into IFRS? Does that make it a conflict with IFRS? Is there a question of adding extra disclosures? Would that be a conflict with IFRS? Well, I think to some extent, if again I take a non-bank perspective, I look at jurisdictions around the world who've decided they might close off certain options in IFRS or add in extra disclosures. Those have, I think in general, been seen as conflicts with IFRS, and they have generally, I think, back down from including those. So just those comments. Yeah.
Thank you, Richard. I would ask Darrel in the way, now you have heard that, the Bank of Italy says we must have additional rules because it's simply not enough with IFRSs because otherwise it wasn't necessary, and all these bloody options, we need to get rid of them because they may not fit banks. So how do you react as a standard setter and former banker? Where would you be on this?
Stig, I think the way to think about this is to start out by thinking about these as not black and white questions. My doctor tells me that drinking red wine is good for me, in moderation. I agree with her. I suspect, though, we're not defining moderation the same way. I think regulations, or the regulatory environment, regulatory invention, can help in helping people work through the process. There are such things, and certainly if we look at the IFRS 9 process, that's produced useful information that has helped people go through the process of implementing what is otherwise a big, brand new standard that's hard to work through. Now, Araceli, hopefully you'll be able to provide us with advice or research in a couple of years' time that'll give us a little bit of an insight into whether or not this has actually worked in the IFRS 9 environment, whether we've really seen more consistency in the reporting. But the fact that the problem with that, obviously, is once a regulator starts to regulate, once you start to write rules, can you actually stop? So once I've opened the door and I've written the first rule, when do I actually stop writing rules? And I think that's probably the same as me when I open a bottle of wine, to be honest. The point is, it's not going to stop me drinking wine. And I don't think it should stop regulators looking to where they can be facilitative in the process. So what I think is useful about the IFRS 9 process that we've just gone through is to provide us with a platform, an opportunity to start to understand what it is that is good about the IFRS 9 implementation guidance that's been launched, and what about that can we learn for the other processes. Common industry, I think, has been mentioned, so it's a single industry. You mentioned we don't write industry-level standards, so clearly we didn't say only banks must do this or only banks must do that, but there's clear case for saying that that might be a starting point. Very widely consulted on, so that there was a lot of input into the process. That's the second thing that might be very useful. A substantial effort taken to make sure that nothing overrid or contradicted the standard. That's an important part of the process. Moving on to a new standard, adopting new standards, is hard. Anything, I think, that helps people with that process is useful. And I think we need to be careful of giving this due consideration and not be nervous about the negative consequences.
Thank you for now. So I'm not sure, well, I think you've all been asked to answer the question, do implementation and application rules from regulators undermine, in principle, principle-based standards, or are they needed? And I heard two of you say yes, they are needed. I heard you say no. Yeah. And Fabio, where would you be on this?
It depends. Because I think that there is not always a sure and direct link between the application rules and the high-quality implementation. We can have some cases in which we can have high-quality implementation without application rules, and other cases in which, even if we have application rules, we do not have high-quality implementation. I think that the point of view of the regulator is understandable because they look at the regulatory ratio of the bank. The regulatory ratio, the most important, the common equity, starts from the accounting equity and then is adjusted for regulatory purposes. So they need to have the highest level of comparability, of common interpretation by bank of the IFRS because they would like to create a level playing field between bank. In this way, it is important to, from their point of view, to have a common interpretation of the IFRS. On the other side, I think that it's impossible to have, with IFRS 9, it's very specific. It takes into account the specificity of each bank. And so even if they would give us the parameter for the estimation of DCL, we would have different results, depends on the real characteristic of the portfolio. So it is impossible to have a clear and homogeneity, but I think that in some cases some application rules can help bank, but we can find the right balance between the principle-based and application rules.
Okay.
And because their objective is to have a smaller range of options that are allowed by IFRS, because they want that at least a highly sophisticated bank, because the document illustrated by Chiara is for the highly sophisticated and big bank in Europe. So they want to have a smaller range of possibility that the banks can use for their financial statements.
Mm-hmm. Yes.
I just wondered if I thought it might be worth coming back on a point, because I think you've talked about optionality in banks, and I think, Richard, it was something you mentioned as well. And I think there are a number of different types of options that the IASB inserts into a standard. Sometimes we do it because we want entities to exercise judgment about the circumstance that best suits them. And I think when a regulator imposes themselves on that option, they are unduly or inappropriately restricting the ability of the entity to exercise judgment. But I think there are other circumstances where we put something in because we see it as a practical expedient. We're trying to make something cheaper or easier for an entity to implement. And unfortunately, almost by their nature, those are typically free options. I think regulators can play a really important role in a circumstance there by setting a minimum standard or a higher hurdle, at least for some entities. And it might be the big listed entities, it might be the very big banks, it might be... But I think in that circumstance, they're exercising an appropriate space within the requirements of options.
Thank you. It seems that the banking the banking industry here, at this side of the table, they agree this must be done. So there are now, application rules and implementation rules and what have you, taking away options and also deciding certain things, what to do, what to disclose. How do we deal with comparability with the non-financial sector, the non-banks? Because of course, well, personally I would be quite opposed if we had the same level of implementation guidance for a manufacturing company or others. So how important is comparability between the financial, or the banks really, and the non-banks? Fabio, is that you that would like to start on that, or did you want to get in here? Or?
My personal...
No, well, I want to say something else. But
Yeah.
No.
Yep.
My personal view is that the comparability between entities which belong to different sectors is much less important than comparability with entities in the same sector. For example, the analysts who follow us follow the banking sector.
Yep.
We make comparison between peers. For our top management, we consider only banks. We do not worry about how oil companies account financial instruments according to IFRS 9. This is not one of our goals. So for us, I think that it's very important to have comparability between the same business sector. This is the most important thing. And then I think that we have some peculiarity in the banking sector. For example, even if the regulators don't issue any guidance, we refer to the regulatory guidance. For example, for the calculation of the ECL for IFRS 9 purposes, I think that almost all the banks start from the regulatory model and then adjust them for IFRS 9 purposes. But we start with the regulatory model. And I think that oil company does not have a regulatory model for calculation of DCF. So just the starting point is very different from banks in comparison to non-financial entities. And we leverage on other characteristics of the regulator. For example, the definition of default. The same IFRS 9 does not give a clear definition of default. They say you can use a definition of default that is consistent with the one used for risk management purposes. Which is the definition of default which banks, risk management of the bank uses, is the one for regulatory purposes. And then it comes with some issue because now we have the change of definition of default for other purposes, and we have an impact on the financial statement even if IFRS 9 does not change. So we have to manage some issue from this point.
Thank you. I'm not sure, well, I think Hans Busch earlier today said something about he wanted comparability not only in the same industry. So it might be slight different views on this particular matter depending on where one is at the equation. Richard, you wanted to get in here?
Yes. I mean, I think the basis of comparability is we come back. Both are applying IFRS with all the guidance and application that we know attaches that. So that, I mean, you know, to say about the extra regulation that banks are and guidance banks are using, we do have to remember that, I mean, IFRS plus all its basis of conclusion and all the other supporting guidance does amount to thousands of pages of text, and reference was made again to those and all the agenda decisions of the interpretation committee and indeed interpretation. So there is an awful lot of common ground between, I think, these institutions, the banking sector and other sectors. But
and Chiara, if you want, do you want to get in here at some stage here at this point, or should we go to the Slido question? Or if you have views,
No,
or do you want to?
okay,
Darrel.
I perhaps just wanted to say something. I thought something that was really interesting in the earlier session was Hans's comment, I think, specifically on comparability. And I think it's important to realize that comparability and business model are not mutually exclusive concepts. You can have a little bit of both. I think comparability is important, and comparability between regulated and non-regulated is an important part of so I think we'll get to that in a moment, but I think it is important.
It'd be quite interesting to hear what the audience says on this particular issue. Is all comparability more important than comparability within the industries? Is it better to compare a couple of banks, a couple of insurance companies if possible, and then other manufacturing companies or manufacturing companies in different industries and service industries and so on and so forth?
Okay.
Now you are on the tail.
wow.
Right. So, yeah. So I think we're fairly reasonably.
I think we have found the definition of moderation here.
Yeah, so basically, it seems, well, it's quite close, but
yeah,
a slight majority. Well, no, not really. Well, some say that an entity-specific circumstance is more important, others say that comparability within the same industry is more important. So that's undecided, one could say, amongst the audience. That's fine, because then we can continue to debate the issue, which is, I think, is important. And we can leave, maybe Richard, you would lead into comments in addition to what we already may have touched upon.
Yes, I suppose I didn't vote, so I've got a chance to express my view here. I mean, I think, just looking at particularly what users, investors, and others have said to me over the years is, I think the two things that are most important is comparability, or often termed consistency, within the same company from one year to the other, so that you are getting these, reasonable trends and time series. And secondly, within a sector, because I think there are a lot of users who are looking at a particular sector, whether it's banking, insurance, or the oil and gas industry. So I think if one was ranking them, I think I would put those two first, and then perhaps the question of comparability within, within, say, regulated industries or unregulated industries in different jurisdictions. So the effect of regulation, I suspect, across the jurisdictions and across different sectors, I think is probably rather still important, but rather less. And I think that's what Hans was saying this earlier on. I think I think we had the academic view as well about this. I do think we have to be a little realistic about absolute comparability. I don't think we're going to get it. I'm involved through ACCA in jurisdictions in around the world, and I think I'm very conscious of the different backgrounds that they come from, and the different way in which financial statements, to some extent, even IFRS financial statements are prepared. And certainly, you can certainly note that academics are always trying to adjust or put in that dimension of jurisdiction to those jurisdictions that are perceived with stronger governance frameworks, as opposed to those that aren't, or indeed auditors. They're normally trying to pick out whether the entity is audited by one of the major accounting firms or not. So I think we can see that there's quite a bit of variability. But underlying it, I mean, that is variability on top of the underlying basis, which I come back to, which is the common understanding of what should be or what is in financial statements based on the IFRS on the IFRS standards. And I think that common base is so important, and perhaps we may be worrying too much about the variations that go on top of that, but in my view.
So it means if I'm a shareholder, I want to buy shares in. So if I go to Italy, here in Italy, then I can either compare banks, or then I cannot compare to the rest. That's it. And then so the PE values for banks might be calculated in a different way from the others. That's okay. Yeah. So how do I choose between a banking share and a non-banking share? But maybe that's not important. But basically, I don't know whether Luca or Darrel, you wanted to add to your views on this?
Yeah, maybe just a few words. So again, I don't think that the issue is black and white also here. So we have a discussion about comparability, and there is a clear nexus between the trade-off between comparability and the regulatory guidance, which I don't think stands in all cases. For example, again, if we come back to the guidance on IFRS 9, so there are several principles dealing with the governance for the calculation of the DCR model, and I don't think that regulatory guidance on how now banks should handle the overall governance of the process is affecting comparability, but probably is just getting the way the ECL are calculated more reliable eventually than for others. So I think that, again, a good share of that guidance is not affecting comparability. I think that for disclosure is different. So I share the point that for disclosure, if there is requirements that differs from other jurisdictions, that there can be an issue. But we will come back later on this point.
Mm-hmm. Yeah.
If I can answer to your question, I think that you cannot decide if to invest in an Italian bank or an Italian oil company basing on the fact if IFRS 9 has been applied by the oil company with some practical expedient or not. This is not the point. I think that the comparability, I think that we need to have all the company applying IFRS, and then the option, the practical expedient of IFRS 9 does not impact the comparability between an oil company and the banking system. Impact the comparability among the banking sector, but does not impact between one and another.
Okay.
If
Yeah.
So I think there's quite a lot of things happening in this discussion at the moment. So maybe to sort of pass them out from my thinking, I started by saying I don't think business model and comparability are mutually exclusive. I think you can capture both the nature of your business model and you can capture your transactions in a comparable way nonetheless, although you might organize them differently in the way you actually put them out there, the information is the same. So I think that's the first thing. I think the second thing is I don't necessarily believe that good regulatory intervention, and I think there's an important distinction here, that good regulatory intervention necessarily impairs comparability. I think what we've seen with principle-based standards, and principle-based is always going to be an interesting space to move in, is that good practice trickles down. So you start with better practice when the first people come out, and I think it's probably worth saying, we're all accountants. We don't want to boldly go where no one's been before. So we tend to get into these things in a sort of a very slow, incremental way. And so when you see a new standard come out, when you see changes like IFRS 9 come out, people incrementally try to change the way they think about their numbers, the way they work their processes. Good regulation nudges them along a little bit. It pushes them a little bit faster into that. And as a regulated industry starts to do that, so I think in time, that good approach trickles down to the non-regulated. If I'm operating in a banking environment where I want my shares to be bought by you, I want to be seen in a comparable way to what you're looking at with other banks, that behavior starts to move through. Now again, this is a part of principle-based across the board. It's not just regulated versus non-regulated. I think we have this issue wherever good practices start and how they sort of move into other areas. So I think we've got to actually think about it from both aspects of it.
Thank you, Fabio. I didn't mean to interrupt you before. Please continue. But
it's good.
But maybe I will try to be more persuasive than what Fabio did. There is an element, I think, that is coming out from this discussion, and it's the proportionality. Mm-hmm. So the standard was principle-based, but where the banks had the complexity and also the tools coming from the regulatory experience and framework to operate a more sophisticated implementation of the standard, there the regulator filled the gap with implementation rules. So I think maybe there is this angle of perspective, the proportionality.
Thank you. Well, we have a. You raised the issue about. Did you want to get in, or did you raise the issue earlier about disclosure? Or are they essential to build a bridge between standard setting and regulation? And I think, Luca, you may, if you have a view on that, we may take that issue now.
Mm-hmm. Oh, yeah. Oh. Okay, for sure. So I think that full disclosure, in particular, the issue of comparability is a big one. And my perception is that there is a need for a higher comparability in financial statements. And I would like to mention 3 international initiatives that I think confirm my impression. So the first one is all the project by the IASB on principle of disclosures. Mm-hmm. There was that very interesting discussion paper a couple of years ago. I think that it was a good chance to raise a number of outstanding issues, in my opinion. For example, the fragmentation of accounting policy disclosures, the need to have examples accompanying the principles, the need to have more consistency and meaningfulness of information, especially when the disclosure requirements are spread across a number of standards. Also the issue of possible formatting of the primary financial statements. So, and I very much appreciate that the IASB decided to follow up on a number of those projects. So I very much welcome any future initiative in that respect. So I noticed that, for the time being, you decided to not follow up immediately on the formatting issue and and the location of the accounting policy disclosures. So my personal hope is that in the medium term you can come back to that. I think that we need also this. The second initiative I wanted to mention is the consultation by the EU Commission on the fitness check for public reporting. So I think that was again a good chance to gather a lot of useful input from industry. And especially from the user's perspective, there was a clear demand for an higher standardization of financial statements. That is something that I think it could be considered at the European level. Third initiative was also mentioned before by the ESMA chair is the European single electronic format. So again, it's something that is dealing more with the digitalization issue, but definitely is something that will increase the comparability of financial statements. Let me finally spend a few words about the experience of the Bank of Italy in issuing regulation on financial statements. So you mentioned this already. We have been issuing regulation for almost 20 years. We think that having fixed formats for financial statements increase comparability. Of course, fixing formats must be made in a smart way. So, of course, you need to have some flexibility in fixing formats. So the possibility to add items, to aggregate items, etc. If everything increases the clearness of a financial statements, that should be allowed. But nevertheless, we believe that having fixed formats can definitely increase comparability over time and across banks. And I hope that this discussion can be raised at the international level as well.
So you have done a fixed format for Italian banks for years?
Yeah.
Mm-hmm. Okay. So it's different from formats in other countries?
Yeah.
Okay, so it's a specific one. Okay. Thank you. Richard, I wondered...
Yes, just to say, I think taking a more, again, moving away slightly from the banking sector, I would say that I think, and in many countries where capital markets regulation is still a developing skill, I think the disclosures are very important because in a way they're the easiest thing to regulate. So you can be looking at the financial statements and going through those with the checklist to see whether they're there or not, and so I suppose that's often a start. I'm not sure that's the best way to regulate and achieve good compliance with the IFRS, but it is a very common way in which it happens, and obviously not just ticking the box for is the disclosure there or not. Obviously, I think in terms of good financial reporting, we obviously want to address the quality of the disclosures as well. And as Luca's mentioned, the IASB is moving on this area, and we're I think very interesting to see what they do when they come to the standards level of the disclosure, where they're going to tackle, I think, a couple of standards at that level, as well as setting these general principles. It'll be interesting to see what comes out. I think if one looks at the current standards, one would say there's all this. Sometimes the disclosure requirements are in the famous bold type. Sometimes they are certainly stated with varying degrees of language in terms of you shall disclose this, that, and the other. And obviously, as we've moved to the more recent standards, we've started to get the objective. The objective of the disclosures stated, and then a less bold type section, which perhaps gives some indication of what might be good disclosure within that. So I think it is a very important area for regulation, and I think that as I say, I'll be interested to see what comes out from the IASB in that respect.
Well, I must admit, having heard this entire thing so far, I must admit I can understand, and it seems that bankers are ready to accept these implementation rules because they've been used to it. And it was normal before IFRS that the national banking regulator instructed banks to do what they should do. And but I must admit, I think it might be that we have got to where we've got to due to the 2008 financial crisis, and may seem, I'm not sure, it may seem that we sit on the back of the banking crisis, and therefore it's very difficult for the banks to oppose any proposals on what to do. It is the regulators have the upper hand at this period of time. It may not be true, but there may be a risk that we are in such a position that we don't have and you could say, a normal challenge of how much regulation should be issued by banking regulators. I can understand that there are, the industry has been in big trouble, so of course they say, yes, we'll do this. But we can see that other industries that are not in the same level of trouble has not been in the same way regulated and has not been issued the same level of guidance or whatever it is. And that may, there may be a connection between the two, and there may not be, because banks may be so different that they need better guidance, they need to know exactly what to do, because they don't know, we cannot make a good best practice type of thing. It may also be that IASB may not have done the exact right decision when they, as a matter of principle, decided not to have industry-specific standards. They decide, and I can see for many reasons it sounds like a good idea. It's the same for all, but it seems it doesn't work. I'm not saying that the panel's discussion says it doesn't work, not me. So basically, when we, have a relatively small listed IFRS company, and you look at their financial instruments, disclosures, you have a receivable in a foreign country, you have 7 pages of note disclosures to comply with all this. Maybe there was a need for different way of doing things if banks are so different compared to other companies. I don't know, I'm just an old simple accountant, but maybe you have
I think there are probably a couple of moving parts in there that are really important to pick up on. I think the first thing is, yes, banking is in itself quite a unique industry, and I think it's unique even among regulated industries because it's one with the greatest degree of comparability of regulatory regimes across the world. So when you look at individual banks, there's a lot of commonality in the type of products they have. There's a lot of commonality in the regulatory regime they operate under. And therefore, there's a lot of commonality in the terminology that's used, the definition of that terminology, probability of default, and other things like that are very common for banks. And so you could argue that the guidance that's been issued reflects a lot of those very special circumstances. I don't think that detracts from the fact that there are things that we can still learn out of the process. And I think the fact that this guidance is out there, the fact that it has led to a more common adoption of IFRS than what we could have achieved, because we're writing for jurisdictions that apply Basel III, but we're also writing for jurisdictions that don't apply Basel III. As you're saying, we are writing for banks and we're writing for non-banks. And so we take a broader view of the whole issue. What the banking sector has done is taken a narrower view because of a very specific set of circumstances. Are there other places where that works? Well, I know, for example, if I look at South Africa in a slightly different context, we have what we call our broad-based economic empowerment transactions. That's an application of share-based purchases, something completely unique to that country, and the regulator has given guidance on how you would apply that. So unique circumstances and other circumstances where you might do something similar. So I think there are lessons that we can draw out of the process. I agree completely with you that we shouldn't be doing a broad-based across-the-board thing for everybody. The IFRS 9 model works because of some of the things that makes it very unique. Well, IFRS 9 for Basel banks is very unique in that sort of circumstance. And then I think on your broader thing with industries, I think the difficulty with that is it has a certain logic. insurance accounting, bank accounting, manufacturing accounting, etc. But I think what we see is such a diversity of business models today that you would end up with so many standards, we'd all sort of lose track of what was going on.
Yes.
The principle-based approach still allows you to have these high-level standards that can be applied at a high level, that can be understood at a high level, and then to an extent that there is some specific industry discussion, dialogue, that can actually draw out some important features where comparability is important for that particular industry, I think there is a role for regulators to play.
Yeah, I wonder really, putting it back to Darrel, I mean, the experience of IFRS 9 in the banking industry, and how would you see the lessons learned from that in terms of IFRS 17 and the insurance industry, or would you be making a sort of difference between the two?
I was hoping with some excitement that I wouldn't get to talk about IFRS 17 this afternoon at all. I think it is different.
Make it short, right?
Absolutely. I think there's significant differences there. I think there is not the same uniformity of product types in insurance that you typically see in banks. Okay. I think there is a very significant variance in regulatory environments across the world that's driven that development. And I think what you end up with is very hard to apply something like a Basel framework in the insurance type of space. But again, I think there's some areas that might be able to learn from.
Mm-hmm. And I don't want this session to go into an IFRS 17 session, because then we will not finish today. Yeah. So maybe we should have some of the questions that that have been gathered together before we wrap up later.
Carsten.
For one of our well-known insurance users, for the sake of financial, you wanted to discuss insurance, right, Carsten? For the sake of financial stability, would it not be logic that also insurance companies like banks have to do their prudential reporting on IFRS standards? Don't they do that? Well, they are on IFRS.
They're prudential reporting, not their financial reporting.
Ah, prudential. Okay. Yeah.
So I'll start on that one to say that there are a number of jurisdictions that are exploring exactly that outcome, and I think those are typically jurisdictions where their regulatory environment is currently, shall we say, a generation or two old. So it's a cost-based, etc., where they see the opportunity of IFRS 17 to upgrade that. I would suspect that the Solvency II model is embedded. People understand Solvency II at the moment, and that clearly provides useful information for the moment. But I think over time we might see some tweaking happen that brings the two closer together.
Mm-hmm. I hope that was enough, Carsten. Given that regulators can require any information they want, why would they provide guidance of an information that is provided to investors? So this anonymous says that they only require information that is important to themselves as regulators. Yeah. Is that I'm not sure, is that a fair statement?
I would start by saying there are probably two things there. I think when you're talking about clearly capital market regulators, then clearly the focus of their attention is investors, so it's appropriate. I suspect, and you might be able to comment more on this, but my understanding of the involvement of the regulators in the banking process is to a certain extent systemic risk. So it's important from a regulator perspective that investors and depositors and others get a common view of the investment of banks' balance sheets and income statements. And so they saw, I think banks are probably the only ones even more reluctant than accountants to be the first out the block showing something different to everybody else. And I suspect that was at least a part of the driver.
And I think that the second part is what Fabio mentioned before. The starting point for the regulatory capital is the accounting equity. So they have a stake because the starting point to calculate the capital ratio is the accounting equity. So that's why they have something to say on how to apply the standards.
We have one still, must be the same. He's very active, this anonymous. Are we overstating the benefits of comparability? The proliferation of non-GAAP measures underpins the desire for for specifics from users and investors. That's an interesting different look.
I'm happy to pick up on this one if anyone else wants to.
Yeah.
No, you go ahead.
I had the slightly embarrassing situation of meeting with South African regulators along with the chair and vice chair of the IASB. And in that particular meeting, the head of the JSE, the Joburg Stock Exchange regulator, said, "Well, of course, Darrel invented normalized earnings in South Africa." So I can take something. I have something of a conflict in answering this question. I think the view here would be that there are two elements. Financial statements provide you with a solid anchor that means that you can compare companies on a one-on-one basis and know exactly, get a view to answer your question earlier about where do I invest. Non-GAAP measures very often give you an insight into the way management thinks about the business. So if management says we ignore foreign exchange differences for the purposes of calculating your results, that tells you something about the way they think about the business and what they think is important and is not. And so the investors I've typically spoken to use both sets of numbers, the IFRS numbers for comparability, the non-GAAP numbers for insight into management's thinking.
Yeah. Do they always produce the gap numbers in their presentations to investors? And that's I think a bit of an issue there. But
and I think that's perhaps another place where regulators play a really important role. I think
Right.
is in making that very clear. It's also a part of the project that we're busy with at the moment to say, well, if we want to build discipline around these non-GAAP measures, we need to build them in a place where we can imply that discipline.
Yeah, because I think, and I think it's down to the investors as well. I would say, if they're just presented with non-GAAP numbers, I think that should be raising some questions. I think in their minds. But I think the question of GAAP and non-GAAP is obviously going to extend once we're already monitoring key performance indicators which aren't GAAP at all because they're non-financial or largely non-financial measures. So that we already have that. But as you say, and I completely agree, IFRS forms a sort of basis of comparability,
it's an anchor.
which I mean, we've only got to think back to a sort of pre-IFRS world to actually, think about the much greater comparability that we have now as a result of implementing IFRS. Whatever sector we're talking about, we have only got to, and so all this talk of comparability, I think, does need to be put in context of and I think the historical one is perhaps an interesting perspective that we have got much greater comparability than we had before.
And that's certainly the case. I think that IFRS has been very beneficial for Europe. Before that, we had 29, 28, 7 different accounting languages. Now we have more or less one, and then I think we also need to ensure we don't go back by having national regulators issuing national rules for different, so that we cannot compare amongst countries, which is, I think, happening sometimes.
But I thought Stephen Mayor earlier on today I think I took a lot of heart from his remarks. That he was absolutely clear that that there shouldn't be national implementation rules, and if there are issues, they should be referred to the Interpretations Committee, who will either issue an interpretation or issue an agenda decision which indicates that where they think the answer lies in the existing book.
It sounds very good. Yeah.
Yes.
Could we maybe there's the second question here. If regulators issue implementation rules, should they follow the same transparency processes as the standard setter? And it's really two questions, try to achieve global harmonization, but maybe if you can take the first one, part of it, should the regulators have transparency processes, so issue them as exposure drafts and then get feedback, and then after that, having listened carefully, evaluated 800 comment letters, how would you then decide on the implementation rules? What should they be?
Yeah, maybe I can say some words about that. I think, I agree with that question. I think that exactly the process that is followed currently. So if I'm not wrong, the Basel consulted on the guidance before finalizing. So definitely we got a lot of comments and we processed that. Coming back to the Bank of Italy experience on the regulation of financial statements, we definitely follow the better regulation process. So we consult on regulation, we got all the comments, and we issued the final regulation after that process. So yes, we need that due process. We need to consult. We need to gather information. We need to consider everything before realizing the product. So definitely agree with that.
Oh, that's very interesting. Yeah. Mm-hmm. Okay. There's a question. Should we have try to achieve global harmonization? Second part of the question, when you issue these implementation rules, so it's not the Danish banking enforcer issuing. And if they do, I don't think they do.
I think the important thing about that one is I think that does come back to the type of issue you're trying to address. So I don't even think that the Basel Committee was trying to achieve global harmonization. They were trying to achieve harmonization amongst Basel appliers or applicants. I think when I talked earlier about the broad economic empowerment, the same process was followed in South Africa, outreach before a regulation was issued. But that was only a South African issue that's unique to the South African environment, and so they were looking for guidance there. So I think there is some element of it depends on what the issue is. I think as soon as you get into the global environment, so as soon as you start talking about this is a global issue, and I think you both mentioned IFRAG and the role that IFRAG plays and the like, I think that's when you start saying this is an IFRAG first issue, and only if that process fails does it make sense to go beyond to look at a narrower group of entities or group of processes.
You said IFRIC and not EFRAG, right? Okay, sorry, couldn't resist. Fabio, do you have any? One second. Do you have any comments in relation to the due processes of banking regulation?
Oh, it's the one described by Luca. They absolutely.
You think that works fine in Italy?
Absolutely.
Okay. Mm-hmm. He doesn't dare to say anything else, right? Thank you, Fabio.
Someone without a Slido, I think.
Yeah.
I haven't directly come across that, no. I will say, and perhaps it's worth just mentioning it as a broader issue. So the way that the South Africans went about this particular issue when they started, they first submitted something to IFRAG. IFRAG looked at it and took a view that this was not a broad, it needs to have a broad coverage. This needs to be more than a single jurisdiction. So IFRAG rejected it on the basis that it was a one jurisdiction issue. And that gave South Africa the license to tackle it. I think the issue you've raised, I suspect if IFRAG looked at it, they may well consider that has broader impact and would consider it in a broader environment.
Okay. There's a question of why can't the IASB work faster with less internal rules, and we don't take that question here because that might take a long time.
It's anonymous again, yeah, right.
There's a question. The latest question is. The audience probably can't see it, we can see it here. Are banks as comparable as stated? Don't we see a number of different business models and diversity in the banking sector? We've just heard that they're all similar. They're all similar, so therefore they are the same. And again, Mr. Anonymous is saying, don't we see different business models? And how does, any quick reactions to that?
Yeah, maybe a quick one from my side. Yes, there are different business models, but we don't have, a massive number of regulatory guidance. So we have guidance where we think is needed. And if I think to ECL calculation, I think that, independently on the fact that the bank is more investment bank than a traditional bank or a universal bank, at the end of the day, they have to calculate the ECL in a proper way. So I don't think that guidance like that one is affecting, differences in business models by banks.
Okay. The difference of business model is well managed through the IFRS 9, which is principle-based. So this is the right way to manage this difference of business model, absolutely.
Yeah. Okay, thank you. I think we're about to close, except that we, as a wrap-up, we would like you to give 1.5 minutes each. We have extended it from 1.5 minutes each. So what guidance do you have to the audience as a last comment before drinks? Or sum up first and then drinks. Yeah. But the heart is full of, who will start volunteering? So no wrap up.
Okay. Yes.
Exactly.
Yes.
Yeah.
Okay.
Darrel, yes.
So I guess a couple of things. I think it's worth bearing in mind that principle-based standards means that principles evolve over time. So how disclosures are actually put into place, how things operate, how people work, evolves over time as people become familiar with the underlying topics. I think is an important part. And I always think about principle-based standards as being a value chain. We set the standard, preparers then go out and do the work to do it. Auditors spend a lot of time looking at that work, consulting with each other. Regulators are part of that value chain, and I think they can provide value through the process, but clearly each player needs to play their part, and none should be overplaying. And I think when one becomes too dominant over the others, you lose the ability to get some of the things that we've been talking about. Regulation, therefore, has a place to play, but it must definitely be something that's applied in moderation. It must be applied at a level that's appropriate. And I think that's going to be the difficult thing. I think that's not to understate how difficult or easy that might be. Judgmental areas, I think, are all the way through IFRS as we expect them to be. And so to establish and talk about comparability, the reality is comparability is a soft concept, not a hard concept. Uniformity, and I think that was mentioned by one of the earlier panel, would be a hard concept, but would not be as useful in terms of information. And then the last thing is to just remind everybody that there are a lot of tools out there for how we achieve the type of decisions, the type of consensus we're talking about. And educational material, IFRICs, agenda decisions, all of these things play a part in the process.
Thank you. Well done in 1.5 minutes. Luca or others?
Yes, a couple of messages from my side. So the first one, I agree. So regulation must be made with moderation. So only when it's really needed for very complex standards and those which it's specifically the banking sector. IFRS 9 is a typical example. I also think to IFRS 13 and a few other standards. The important thing is that there is no contradiction between the guidance from regulators and the standard setters. So there is a need of a proper process for issuing that. But at the end of the day, if made properly, it can be positive for both the regulators and the standard setters themselves. Second, in terms of disclosure, I think here there is a need for more uniformity, and I'm thinking about the hard uniformity rather than the soft one. At least for the primary financial statements, I think that having a common format for information can definitely improve comparability among entities. So, and I think that discussion could be made at the European level as well.
Fabio?
As a bank, we like IFRS because they're principle-based, and we think that we need principle in a world that is evolving continuously. So it's better to have a principle that allow us to manage with coherence in time the different situations, different issues. We understand the position of the regulator, even if sometimes we do not like to receive too many strict regulation. And, but the importance is that these strict rules are in line with IFRS 9 or with the other IFRS that not overweight the other IFRS.
And last but not least.
Oh, right. Yeah, I think I would say, again, speaking from outside the banking sector, I would say in answer to the main question we've got, should regulators issue implementation rules? I think absolutely not needed. And indeed, there's a lot of source. If it's not needed for what we're trying to achieve, which is better financial reporting and compliance with the principle-based IFRS. And so I don't think we need the regulators to issue implementation rules. And I think Stephen Mayor was clear, as I say, this earlier on that question. What we do need is better application, and I think Darrel's mentioned a number of source of. And I suppose that's the difference between rules and, to some extent, nudging guidance. We do have a lot of source of good practice, whether it's from the accounting, the major accounting firms, whether it's from the reporting labs which are being set up, market pressure, and so on, and not least the auditors themselves who have their own guidance, which they're expected to apply, and therefore must affect their interpretations of how the standard should be applied is a very real issue, and that they have their own guidance, and if clients are not following that guidance, then there's going to be a bit of a debate that will ensue. And last but not least is last in the chain that Darrel was speaking about, I guess, are the regulatory enforcers, and so we do want good enforcement. I just don't think we need rules from those enforcers. What we want is good is work by them to achieve good application of the standards in practice.
Chiara, would you have a...
Well, I think what we can say is that there is a role for everyone in this process, and as far as we keep it cooperative and as it is, I think IFRS 9 has been a good example so far from what we are saying. Yeah.
Thank you. Thank you very much. Would you help me in applauding the panel?
Very good.
And back to Patricia. For sum up.
Yes, I know, my label has come off. Yeah.
Well, thank you to everybody for giving me the easiest part of the day. And I would ask panel members to forgive me if I've left out their favorite points. I think probably the first thing that struck me is that Europe has matured in terms of dealing with accounting standards. We used to talk so much about, I want my national gap back, my answer's better than your answer. And today we talked about Europe. And I think that is a very real development and something we should all be proud of. I know when it comes to a change to a standard, we all get very excited and very nitpicky, and we don't like this and we don't like that. But we didn't play the usual French, German, Italian, Spanish hate each other. We didn't play big countries versus little countries, but we talked about principles. We talked about proportionality. We talked about how rules and principles should work together. So for the first panel, the focus was on should IFRS no, let me get the right way around. Yes, should IFRS be more rules-based to support enforcement? And there was a really good discussion about principles and rules. For those of us who go back far enough, when this discussion got really heated in the late 90s, the FASB wrote a paper which is the rules for writing principles-based standards, which went round the standard-setting community at high speed. The other thing that nobody touched on, but I think is really important, is when you want to simplify things, you often write more. There was the great Australian experiment in simplifying the tax law. So it went from that to that. But it was simpler. So now, where did our panelists take us? We worried about the extent to which guidance would undermine principles-based standards. So if we start putting in rules, are we going to lose the principles? And I think it was generally felt that the two could be managed together, but they needed to be sympathetic to each other. The rules shouldn't become so hard that you lose the principle. The rules shouldn't become so big that you've got so many rules you can get around them. I like the recognition that we always say FASB rule-based, IASB principles-based, when the answer is they both are somewhere in the middle. I thought it was a real revelation that an IASB board member could say, we don't mind other things explaining our standards, because if we go back a few years, standards were standards and other people shouldn't touch them. I think that what we've seen is a lot of trying to come together to make the whole system work. That how can we get the standards to work for investors? How can we get the standards to work for prudential purposes? And with the regulators and principles and rules all coming together, then we've got a lot of opportunity to reduce overload on preparers. Because the overload on preparers comes from, I've got to do it this way for this purpose, I've got to do it that way for that purpose, I've got to do it that way for that purpose. And the more we can meld these sensibly and sensitively, the better off we're going to be. So I'm bringing the two panels together to some extent because the topics were similar but a different focus. We had an interesting discussion about comparability versus uniformity. And comparability is trying to show similar things in similar ways. Uniformity tells us all that the number is 42. And I think we have generally wanted to move away from uniformity towards some form of comparability. We nearly strayed into the industry-based standards. I was interested in watching how we went there, and then we worked out that possibly wasn't such a good thing, and maybe we should back off because, I mean, it's virtually impossible to do. The IASB is thinking of just doing some industry-based disclosure examples, and I think that's an uphill battle. How are they going to choose which industry? The industries that are chosen will hate it, and the industries that aren't chosen will feel neglected. So, Darrel, I hope that you're still at the board when you get there. I was interested that in both panels we had this focus on maybe rules belong with presentation, and we were going to see that with the primary financial statements project. Now, we've been following the IASB for a long time at EFRAG, and we've been talking to our various groups. And the only certainty is that preparers don't like it. Some of them don't seem to be allowed to use unusual, infrequent, recurring the way they would choose to. Some of them don't like being forced to do nature of function and not a free-for-all. This IASB trying to interfere in management performance measures is close to unforgivable. So we will all be watching the EFRAG draft comment letter with great interest when the board manages to work through that nightmare. the Slido told us that, as you'd expect, we're all over the place. I don't think we got enough information to say that users are always on this side, preparers are always on that side, and regulators are in a world of their own. But some of us think they are. I was interested in Richard's trying to pull this discussion away from banking, and talk about the rest of the world, which isn't minute. I loved Stig's attempt to avoid IFRS 17, because all sensible people want to avoid IFRS 17. And the problem with the regulation IFRS 17 is that where Basel and IFRS 9 grew up together, IFRS 17 and Solvency II have been growing in completely different plant pots and different gardens, and I don't think they've heard about intertwining yet. But I think that'll come as that area matures. It was very interesting, this first panel move, that we've got to think beyond financial information. And we know that the IASB over the decades has been pressured to be the standard setter for it, because it's actually good at setting standards, even if it doesn't know much about non-financial information, because we're not sure they've got the right people. And I think what we're starting to see is an acceptance that this sort of work also belongs with a deep, experienced standard setter, because more and more people are saying we need to have common standards. We know there are so many frameworks that, you know, choose your framework to give you the answer you want. That area is 40 years, 50 years behind the financial reporting area, and I think they could benefit from some of the things that financial reporting's learnt over the years, and it's taken them years to learn it. First thing is find a conceptual framework that everybody likes. So I've covered consistency, I've covered regulation. I think, to me, they were the key themes that we brought forward. I think some of the detailed themes are going to be very useful when EFRAG starts thinking about its next lot of own research projects, because we've got some questions that came up that we can work our way through and think about. I like the fact that all the people, when they talked about regulation, started to say, well, regulation's got to be simple. And we've got throughout the discussion a number of sort of what I'm going to call rules for regulators. Don't try and rewrite everything. Keep it simple, do it when it's necessary, proportionality, those sorts of things. It might be quite useful if the IASB told us when taking out an option is not damaging IFRS compliance and when taking out an option is. In a former life, when I had to compare IFRS to an Asian set of accounting standards, I made the executive decision, because nobody else would make it, that taking out an option that was a free-for-all did not affect compliance. Taking out an option which wasn't really an option, but it was, in this case, do this, and in that case, do that, was non-compliance. And really, I think that's probably about all I've managed to pull together in the time we've had with this vast range of views. I think it was a very rich discussion. I think we should be very grateful to the facilitators, because that was a particularly horrible job. And I think now I can hand over to you, Saskia, to close us up and head us towards the drinks.
Okay, good evening. Thank you, Patricia. You saw I left a difficult job to Patricia, and I'm just going to say a few words of thanks before the drinks. And so that will not be long. So your drinks will be earlier than you expected in the program, so that is probably good. So I would start with thanking all the speakers. We had Jean-Paul giving us the welcome words here. Then we had Michel Prada. I think for all of us it was a great pleasure to see him again after a year or so, as he mentioned himself. He gave a plea for a new form of standard setting and reporting to accommodate future challenges. He referred to digitalization and to ESG reporting. And I also noted that he said, don't rely on accountants to save the planet. That is sort of what I scribbled down as well as a note. Then thereafter we had Steven Major as a keynote speaker. I think many of in the panel repeated what he said, that it was not the intention to have interpretations of ESMA or the regulators. He also touched very much on non-financial information. Patricia just mentioned that there is a long way to go with all the frameworks that are around. Patricia gave us a good insight in what she took away from the panel, so you may have other takeaways or other insights, so I will not go into that. Pervance Perez, she's already gone. Unfortunately, all our key speakers are gone, but we thank them all. She gave a good setting the scene, like Chiara did for the last panel, so we're very happy with that. Thank all the speakers in the panel, and the facilitators, Ellen Dekkers, Hans Buijsen, Karsten Gaunsauger, Araceli, Klaas, Tina Sway, and then also Stig, Fabio, Richard, and Darrel, and Luca that you had here. I see that there is a bit less people here than in the beginning, but still is a number. We could also see that on the Slido, where we saw that, I think on the maximum we saw 65 or something, and then it went down to around 40, and assume that not all of you typed that in. But I think you were a very active audience. You gave very active contribution. Also the questions that we had, and probably you have not seen all the questions, because we have Lina behind there who is filtering the questions. So you may have asked a question, and if it was an inappropriate question for the panel, assessed by us, then the question was removed. So there might even have been more questions. The reason why I wanted to have this closing remark, because I could have left it to Patricia, was that I wanted to say special thanks to Patricia. First of all, as Master of Ceremony, doing the difficult job of take away messages, because actually you have to do that on the spot. You cannot prepare that in advance. So Patricia had to work very, very hard. So you heard already from Jean-Paul that Patricia will retire from EFRAG tomorrow. But of course, Patricia will not disappear from the reporting scene. I cannot say loudly, but she said already some things that she's going to do. So you will see that. So a big thanks for Patricia for today and her 6 years of commitment, or almost 6 years of commitment to EFRAG, her endless energy, valuable contributions, and for me personally, she has been a great sounding board and help, especially in the last few months. So super. But Patricia's leaving, but then of course our management team cannot do it without Patricia and without Filippo. So we have a new project director, Katrin Schöne. Katrin, stand up. That's why I wanted you to have you on front here. So Katrin joined the management team 2 weeks ago, almost 2 weeks ago, and she worked 10 years with the German Financial Reporting Enforcement Panel. So if you haven't met her, the drinks will give you another opportunity to talk with her. Then, of course, this conference would not be successful without a team behind it. And even if we learned from some speakers that the message was, say what you want, we actually have done a little bit more preparation than that for the panels and for some other elements. And I want to thank Christina, who you all know because she sent all the emails to you, Robert, who is behind there and has been done a lot for the technicians, but also for the panel discussions. We have Lina, who did the whole Slido. And we have Cecile, our communication managers. And of course, there is some other staff here as well that help with the reception desk. So we are all very grateful for that. You will see that with all these techniques here, we have a video that will be soon. Will not say tomorrow, but in the coming days that will be available. So if you want to watch yourself or listen to it, it will be the whole conference, so it will probably be quite an effort to listen to that. We also will have a shorter video, but it will take a little bit, and there will be a report on this. So that's all what I wanted to say, and so I hope you will join for the drinks, meet with Katrin, with all of us, of the staff here, and thanks again for being here. Thank you.